All right. It is taking a second. There we go. I believe we are now live. It took quite a second, but we got 11 people joining us from X, and we are not yet seeing anybody from Cashflow Chronicles. There we go. Cashflow Chronicles just came in. Mr. Patel, always a good day to see you. It's been a month since our last meeting. How are things with you?
They're good and they're bad at the same time. They're good in the sense that we're getting these deals, but it's bad in that the reason why we're getting these deals. It's one of those things that you just have to kind of weather through it, man.
I personally am
So,
excited because a lot of the stocks, and the reason why I'm excited is a lot of the stocks that I have been buying, their
mhm,
thesis hasn't changed.
mhm,
If anything, that might have been tweaked slightly, delayed slightly, but nothing is going off course. And I'm able to
mhm.
purchase things for prices that either one I haven't seen in a while, 6 months, maybe 12 months, etc., or second, prices I never thought I would see. In the case of the stock that we're probably going to talk about most today, which is Venture Global. But
Yeah.
with that, it provides good opportunities. And in going through the earnings report today with Venture and the earnings report for a lot of the companies, it just continues my conviction, right? And
Mhm,
what I think a lot of people don't grace and ground themselves in is when things like this happen, they might not necessarily have the due diligence to keep that conviction, and they might sell
mhm.
too early. Now, I'm not saying
Yeah.
don't sell. I'm not saying don't adjust your portfolio during times like this. That's obviously something that you should potentially be thinking about doing. I've done the same in this pullback.
Mhm.
Things that were kind of auxiliary, and I was like, you know what? Let me take that money and adjust it to here because I have higher conviction here, and on the rebound, it's going to be much better, etc. But at the same time, don't just blanketly sell out. In my opinion, don't just blanketly sell out based off of just some slight numbers coming back to a little bit of reality when your vision is 10, 20 years down the road.
Yeah.
A lot of people starting to question why they got into stocks. I'm seeing a lot of people, this is something I also want to bring up, people being like, Matt, what should I do with some of these cash secured puts that I bought into? And I'm like, well, why did you get into those? And they're like,
Mhm.
I don't want to own Rocket Lab. It's like, well, then why did you write a cash secured put on Rocket Lab? Right. So hopefully this becomes a lesson for people, and hopefully it's a small boo boo, not a big boo boo, for people that are potentially chasing things when the market's hot. You get a little bit of opportunity to make mistakes and still come out on top. And when you
Yeah.
see kind of pullbacks, 5-10% for the broader market, which ends up being 20, 30, if not more percent on some of these other stocks, you start to see your mistakes magnified a little bit. And
Yeah.
whether or not, I think that that's the market testing you, that's the world testing you to see if you're ready for the next level of being able to manage money or being able to, because if you make a mistake and you're only at $10,000, why would the world hand you 100,000? If you make a mistake at 100,000, why would the world hand you 1 million? Right. So that's
I don't think it's that correct.
no.
I don't think there's any philosophy behind it. I think this is just normal dynamics of like market cycles going up and down. Like I always find that, you know, in an ideal scenario, you want everything to go up and to the right all the time, right? The challenge with things going up and to the right all the time is that you don't get the opportunities to buy things and you don't get opportunities to sell things. Now, one of the one of the things that sometimes can hobble you is that even if you find something that may be overvalued, you can't necessarily sell without the tax implications, right? And so that sometimes can screw with your head. Like as an example, like I did want to trim some of my cruise line position like earlier in the year, but I didn't because I was like, well, if I just hold to May, you know, now I'll have long-term cap gains with short-term cap gains. And I didn't sell anything because I was like, I'll wait it out. Now they've come down a little bit, and it's missed opportunity because had I sold, I could have bought them back at a much cheaper price today, even though I knew that they were overbought at sometimes. But when it comes to it, those are just like minor things that happen in the market. I think more so you have to understand the background on why things are going down. And if you understand why things are going down, you'll know why things are going to go back up again. Like when I first came into investing, I didn't realize why things went down or why things went up, other than just, hey, listen, markets go up, markets go down, right? That's it. Now I understand what the reasoning is, valuations wise, momentum, fear, greed, all that stuff. And I can factor in certain aspects to it and figure out, like, okay, what are the chances of something going back to normal trading ranges again? And those are the kinds of things that you just have to basically understand. So right now we're dealing with geopolitical issues with a new administration that's coming in, just throwing policies out there, whether that be tariffs on Mexico and Canada, which is our largest trading partners, dealing with this whole Ukraine thing. And the broader implications of that can fundamentally trickle down into the economy and then bubble that going into the companies that you're invested in, right? So as an example, when consumers feel less confident, they spend less. If they spend less, that means that the earnings for the companies that you're invested in, which are directly tied to mostly, to consumers directly or indirectly, could end up taking a bit of a beating, right? So right now, the market's confidence is down. The administration has basically put in a lot of uncertainty into the markets. And so as investors, people who are managing a lot of money, because they're always managing money, but they're always managing risk, they're not trying to deal with this volatility. So their thinking is, you know what? Is this 2008? Is this 2000? Is this, 2020? Like, we don't want to take a chance of, losing 40-50% of our portfolio. Let's jump into some safer things to make sure that we're protecting our returns, especially since a lot of people came off of two really strong years of returns, right? So I think right now we're looking at basically the market kind of like pushing back a little bit against some of the policy things that the Trump administration is putting around, by basically saying, look, you may find uncertainty to be a tool that you're using to get your policy objectives across, but we as investors are not in for that. Like, we don't want to deal with that volatility. Now, that's okay with me, because that's also means that me as an investor, if I am willing to basically ride the volatility and accept it as a normal part of investing, and my time horizon is long enough, I know that I can actually, outperform when other people are pulling back. I can kind of double down and put in, and so I think this is an opportunity, of course, but the one thing I'll have to just be very careful and say is that you better have some really big cojones to invest right now. And the other thing to also keep in mind is that right now is not the time to do options. Options are a time where you know that there's some level of focus and stability going in one direction. Options right now, you are limited on time, especially if you don't do like really, really far out of the money leaps. And so you can get crushed by the theta decay if you're trying to do short-term options, and you can also make a lot of money in options too. Don't get me wrong, but there's a bigger chance that you're going to end up dealing with a lot of headaches, a lot of stress, and you're going to end up getting tilted, and then you're going to start losing money. So the best thing to do right now is find the companies that you like, that are undervalued, buy the stock. If it goes down, keep some reserve cash, buy, or, get your higher conviction plays and buy. But definitely do not go like, okay, let me go full port options on, this going to recover by next week, and I'm going to buy, take like $100,000 and put a, like a 30-day option thing on.
We're only down 10%, not even on the macro, right? So it's like it could go down to 20, it could go down to 30, and I think with that, like you stated, it'd be probably premature to be able to go into options here. But interesting. Anything before we hit the intro button, Mr. Patel?
Yeah, just one thing. I would say that based on what I'm seeing, it's probably not a bad idea to like tamp down growth estimates for at least this year. Maybe next year we could see a tailwind, but this year we could definitely see some tragedies happen. So we'll see what happens. Let's cue the intro.
All right.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good. Huge upside potential, upwards of $60,000.
All right. Man, I'll say it is always a great day to be back here with the Christopher Patel, March 6, 2025, Apple 235, Amazon 201, Dutch Bros at 65.5, Google at 172, Palantir at 82, SPY at 575, the Qs at 491, Bitcoin 87,000, West Texas Intermediate at $66.52, and Henry Hub Gas $4.27. Now, before I hand it back to you, I agree with wholly what you stated with respect to options. I see a lot of people trying to say, oh, we're going to bet on some sort of short-term recovery. We're going to bet on a May. We're going to bet on an April. And that is what it is. It's a bet, right? I think you can see a second leg or third leg even down from here. It's not like we are down 30%, 40% where the bottom is likely to be in. And coupled with that, just with what we've seen, volatility is spiking, right? And so we've gone to a way of having very low volatility to high volatility. What happens with high volatility? You're going to pay high premiums. And so even though we're going down, the options contracts that you might be buying in the short term, medium term might still actually be inflated. And so it doesn't necessarily make sense right now to potentially go into those things. Now, long-term dated options, leaps, I mean, if you find a decent one, but I still would, like, I've been, for example, the things that we're going to talk about today, I've been buying shares, right? Because of the volatility, I haven't been buying a lot of leaps, just based on the fact that, hey, these are companies that I want to hold 5-10 years. So why would I be buying leaps if that only limits me to January 2027 or at most December 2027? A lot of these things I expect to pan out to 2030, 2032, 2035. So why limit myself? Right. And that's just my investment style, just kind of tuning in with that. But can't say that I haven't been buying any leaps. That'd be a lie. But I would say the majority of the money over the past few days has definitely been with respect to buying more shares. So I echo that sentiment. People just need to recognize, I think still, and this is something that comes with experience, it comes with time. Do some quick mathematics, right? And if you buy a stock at a certain price versus if you buy the option with the current premium, if the stock price hits X price, right, will you come out ahead at expiry buying that option or the stock? And I think a lot of people still don't do that simple calculation, right? When we're talking about, hey, you're buying this $12 leap for $2, that's a $14 break even. If you think it's only going to $16 in the next 2 years, right, just buy the damn stock, right? So it just doesn't make sense how some people might be viewing some of these things. And I'm not saying that that's an accurate example or anything like that, but just do some quick mathematics, right? It's literally in the math. Sometimes you'll realize that it makes more sense to buy options. Sometimes you realize it makes more sense to buy the stock. So
yeah. Let's go through our company of the day, Venture Global. I know me and you have been bullish on this company. We actually have it. I think it's our largest holding on our portfolio. We added a little bit to it. I wish we had waited a little bit now in hindsight, but it's fine. I think it's still got a lot of
cash
promise.
influx next week, man. Cash influx next week.
So we got more cash to buy, so that'll be good. So let's just quickly go over the earnings. But before we go over earnings, I want to basically demonstrate a couple of the reasons why it went down so much. Because if you look at Venture Global today, it got sold like there was no tomorrow. I mean, there was no point at which I in the morning time, I thought it would have like a nice quick reversal going into the rest of the day. But believe it or not, there were some other things that are happening in the background that I didn't realize that basically caused, hold on one second, more of the sell-off later in the day. So let's just take a look real quick. So Venture Global today went to $9. So literally IPO'd about 40 days ago.
Yeah.
At 25, now it's down to $9. Talk about a bad time to IPO. And that's after originally setting an IPO price of $50 a share, right? So now they're literally down. If you do it from there, they're down like 80%. So they're 62% down year to date, which, for the average investor, it's a pretty significant amount of being down. But this is where some of the opportunities lie. You know, when things are down so heavily, people are irrationally selling, not understanding why things go down. So today they did their earnings release, but before we go to the earnings release, did you see this today? Let me just bring this up. Actually, let me see. TTF futures price USD. So this, let me just bring up. Okay, so this is in EU terms, but let me put in dollars and USD. Okay, so forward contracts for natural gas in okay, here we go. This one will work. In Europe actually crashed today. Literally on Venture Global's freaking let me just bring this up. Earnings day. So look at this. So it had spiked all the way to, let me just put it on, there you go, on USD. So this way we can see. Prices had spiked all the way to about $17.58 per MMBTU. They have crashed officially now, and they've gone to like about $12. So a lot of this is just speculators in Europe dumping their futures contracts. There's a couple of legislative things that are happening in Europe, which is basically allowing for less scrutiny on storage. I have to basically show this thing, but let me see. EU nat gas storage. Storage levels are actually, dude, this is why I hate freaking Bing. I don't even know why this thing got loaded. I have Edge, and sometimes Edge defaults. I think because my wife has been using my computer, and basically her company makes her use Edge, which is like same thing. So I accidentally, let me just log off of StreamYard, go down Chrome, and I'll get back on here. Give me 1 second.
Okay. Let's see. Do I have? I don't have this in dollars, and let me see if I can pull it up. What Chris is. Does this have it? Yeah, but that doesn't have it in dollars, but it shows the same thing that Chris wants to show. Meh.
There we go. Okay, we're back. So I'm just mirror my screen. There we go. Okay, so let me go back to EU natural gas. Okay, so here's what's going on. So right now, the European Union is proposing a 2-year extension where they want to have a certain level of target when it comes to filling their natural gas. And so there's actually been some pushback about that. And that's what's causing people to say, you know what, maybe we don't need to have as much like, storage filling right this second. Because when they have these high targets of making sure that they have a ton of natural gas for winter, they can artificially cause demand to be higher. So right here, usually when demand is low during the summertime, that's usually when, storage right now, especially considering that they're pretty much cut off from most Russian natural gas imports. They used to be about 40%. I think right now is about 18%. But if you look at like natural gas storage in Europe right now, their levels, let's see. Where is there? 1 second. Natural gas storage levels. Okay. Not this. Nope. Let's see. Okay, there we go. Here's this. So you can see here that storage levels for natural gas in Europe are about 43%. Usually what they do is throughout the winter months, they use their storage up, and then it typically, gets down to about here in April, and then they start refilling again. And all of these cargoes come in from, used to be the Russians, they would help fill it up, but now it's actually going to be the US. So a lot of European and I think some Middle Eastern ones. So you're basically going to see is demand for natural gas start to pick up later part of this year. But because of this regulatory change where they're not necessarily requiring themselves to be at like a really high level of storage, people are saying, well, maybe demand is not going to be as strong relative to its like last couple of years, especially if this whole thing with Russia and Ukraine gets resolved, then that means that there's a possible chance that Russian nat gas exports are going to start to resume again, right? So these are all the storage like locations around Europe. So you can see like Germany's down to 46%, Netherlands is at 31, France is at 28, the Spanish are at 68, Romania is at 38, Poland's at 59%. But basically all of these things, as time goes on, they're going to have to like refill them. Okay. Natural gas isn't just for heating. It's also for things like fertilizers and stuff like that. So, but that's a side conversation. But the point is, natural gas is a very important part of the European economy. So, if Europe's demand wanes, then usually that will cause prices to come down. So, one of the things that we saw was this level of natural gas USD TTF. Let me just show you the price chart. Yeah, you can see here that it's basically gone down significantly, right? Mm-hmm. It's gone back down to like September levels. Now, why does this impact Venture Global? Well, because, they essentially have a ton of spot cargoes right now that they were looking to sell into Europe. So if your original target was, hey, we're going to get $15, $16, $17 per MMBTU, and now it's gone to 13, that means that your profitability for this year may not be as high, right? And if their profitability is not there, then maybe there should be a valuation reset lower. And so I think a lot of people seeing this trend kind of just move things down. Now, why is this an opportunity? Well, in my opinion, there's a couple of reasons. Number one, I think that this move down in natural gas is something that's probably going to be short-lived. But that's, again, this is why they call natural gas the damn widow maker, right? You think that's one thing's going to happen, and then the complete opposite can happen. Eventually, Venture Global is going to be transitioning to less dependency on spot and instead more dependency on fixed take rate contracts, which is why we're invested in them for the long term, right? Because they are going to be putting out just so much volume in the future that it's going to be very, very profitable. The challenge is the spot prices is where you're basically making a ton of money. And over the last 2 years, when the Russian-Ukraine war was at its peak, they were generating a crap ton of money in revenue because they were able to sell those cargoes at a really, really attractive price. Now the volumes that they're exporting have gone up significantly, but the prices have come down, right? So,
precisely. Yeah, I think that's a good way to look at it. I think one of the other things, though, and then somebody said it in the chat, is if you get to a place where you aren't necessarily filling the capacity in the summertime prior to winter, if you get into a rush, the next thing you know, you're going to have huge spikes potentially in prices later on. And so that's one thing that I think, while they might be being smart to lower demand, I think that's something that could lead to volatility once you get into wintertime if there's a severe cold snap or something of the like. I think last year wasn't so bad. But I think that's something to keep an eye out for if they're not necessarily going to be filling their reserves as quickly as possible. Second, I think they're going to continue to be in a bad place just based off of the fact that you have a lot of windfall taxes in the UK, as well as just pushing of natural gas projects throughout the rest of Europe as well. That is leading to probably a shortage in the long term. So you might have some production now that's helping supply the European production. But unless you're talking about Cyprus and maybe some of the southeastern part of Europe, which I think a lot of that is going to go towards Israel and potentially Egypt as LNG, then it's going to be tough. And I think the prices for European Union are going to continue to increase unless they relax a little bit, comparable to what the United States has done, right? Focus a little bit more on developing your country's resources, but instead they're trying to outsource a lot of that to align with the 2015 Paris Agreement. And I think that there's still this opportunity. That said, you still have a lot of opportunity to export to Southeast Asia, specifically Japan and places like that.
Korea.
So,
yeah.
But overall, before we dive into the call, I was very, very pleased. So I know that people are probably saying, holy crap, man, how can you say that the stock is down 35%? Well, I'm looking at the actual company's performance itself. And I, to be fair, was very impressed by what I saw, as well as the future forecast, coupled with the project updates that I saw, and getting that conviction that Chris and I had a month ago when we had the first meeting, specifically outlining the long-term potential of this organization. And so we heard a lot on the conference call about the commissioning of the Plaquemine ramp up and getting that up to speed. And they're basically not fully commissioned yet, but fully ramping up to the phase 1 of that project. We heard a little bit about how they're potentially going to be bringing on phase 2 in just a short little bit of while throughout the rest of the year. And then also an expansion project, a brownfield project, which was not in our previous discussion. That's something they unveiled that was new today. And then they talked a good amount about CP2, Calcasieu Pass 2, and when that potentially could start to become commercial as well. So lots of potential with that, and a lot of opportunity for additional cargoes. To give people some context, I think there was like 155 cargoes in 2023, throughout all of 2023. It was slightly down, 151 or 152.
Can you scroll and show people? Because I think
151, 152 in, I think, let's see, where am I chatting?
Right there. No. Higher up. The right there. Calcasieu. That's the one.
There you go. Yeah. Okay. So it's 143 versus 140. So in that respect, slight down in terms of total volume, and then coupling that with the fact you can see the average liquefaction costs, you're getting $7.28 in Calcasieu, the Calcasieu project versus the $12.23. And so that's kind of what you're kind of looking at with respect to the reason why the revenues were down pretty substantially. I mean, I think, do we have it on here in the headlines? Yeah. So revenue was down from 7.9 billion to just under 5 billion. So that's a pretty significant decrease there. And then net income was also down 2.7 billion versus 1.5. And then EBITDA was down from 5.1 to 2.1. But keep in mind, as Chris kind of stated, things are trending in an okay direction, but spot prices are also based off of how much you can get at the Gulf Coast, right? So we're not selling Gulf Coast at Henry Hub, right? We're selling it at $6-7 and then shipping it over, and then there's a margin that you get between there. And so that has come down substantially comparatively to where we were in 2022, and then even more so in 2023. And so there's that. But I think the thing that I'm most encouraged about is they gave a rather conservative, and I think this is another reason why the stock was sold off, a rather conservative outlook on EBITDA, and that's 6.8 to 7.4 billion in adjusted EBITDA. And so if you think about the company's current market cap after the decline of about 22 billion, you're looking at a price to EBITDA on an adjusted basis about 3x at this point. And so that's pretty cheap, especially considering that a lot of this EBITDA actually shows up as net income, and we can kind of get into that. But one of the key things that and I'm just going to keep running through it. One of the key things I think that people need to recognize, and they talked about this very heavily on the call, They went from 18 trains in fiscal year 2024 to by the end of this year being at 50 something trains, 56 or so trains is kind of where they're getting at. And with Plaquemine, they're basically turning on these trains and seeing 140% nameplate capacity. So those first 10 MTPA of trains that they brought on, they're actually seeing 14 MTPA. So instead of the 10, which is what they sanctioned on, what they got all the economics and did all the economics stuff on, they're actually seeing 14. And that's part of the reason why, as well, that they're so excited about the second phase of Plaquemine, because they're just saying, crap, well, we're going to be able to increase the actual overall output from 24 MTPA like they were thinking, right? They were thinking it was going to be a 20 MTPA project. With the upside, they were thinking they were going to get to 24. So, a 20% increase on that. Well, reality, it's probably going to be 27.2, which if you think about it, that's about a 30% increase compared to what the nameplate was of Plaquemine, which was 20 MTPA. So they already had it on the books as 24 because they were expecting excess capacity, but it's up to 27. So that means, if you think about it, a crap ton more of exports, a crap ton more of opportunity to export more spot cargoes within 2025, and then eventually way more overall spas. And last, I'll talk about this, and then I'll hand it back to you, Chris. Is they talked a good bit about where they're at with respect to their spas versus what they're going to use as spot. And so if you guys are paying attention, of the 50 MTPA of capacity that they've sanctioned, keep in mind they're getting excess above that capacity that's been sanctioned. Of the 50 MTPA, they had 39.25 MTPA on spas. So pretty much 10 MTPA in Calcasieu Pass original project, 20 MTPA in the Plaquemine, so that's 30. And then they had 9.25 MTPA in the CP2 project. Now, keep in mind, they're all producing above that capacity, right, by 20 to 40%, as we just talked about. So all that is going to be spot. But here you're talking specifically around the total nameplate capacity and where it's looking, right? So what's already been delivered, what's in commissioning and production. Delivered is in the green, and you're looking at the right-hand side here. And so you're talking and looking at what is currently in capacity, right? And what they're actually going to be getting themselves to in terms of actually being able to export and make. And then you could follow with the which is this purple line, right? And then you have the actual trains here, which you kind of see towards the end of the year. You're going to get close to that 56 trains that I was talking about. And then they have the Plaquemine Phase 2 trains, as well as the Calcasieu Pass 2 trains that are already being fabricated and are already pretty much on the way to being able to export. So you're talking about, and this is where I think it's hard for people to understand where we're at in terms of being like, holy shit, this is really cheap. Let's buy it at $9, $22 billion market cap, and where it's going to be. Because keep in mind, yes, we only made 1.5 billion in net income, 2.1 billion in adjusted EBITDA, but you're literally 3.5xing that as you go into fiscal year 25. So,
and usually these things, if you do a just based on some of the other terminals out there, so usually you'll get like EBITDA multiple of about 10. So if you're thinking, let's say on average of 7, if you end up hitting your 7 billion in EBITDA, that means that technically the market cap should be 70 billion, which is 7 billion times 10 minus 30 billion, which is their long-term debt, which ends up being a stock price, market cap of 40 billion, right? Which is fair value. So right now the company's trading at 22 billion, So if they're able to hit their target of about 7 billion in EBITDA, that's what they're going to be. Now, let's say because spot prices, all these things can change, and they only do, let's say, 6 billion in EBITDA, right? Which is under what they're currently targeting. You're still talking about you're still talking about $30 billion of, there would be 60 billion in enterprise value minus the 30 billion in debt, which ends up being 30 billion. And that's considering that they're probably going to pay down some of that debt in the coming years, so it ends up being a very, very attractive figure. And there's actually something very funny. During the earnings call, they mentioned share buybacks already, starting
Yep.
share buybacks. Did you notice that?
I was going to say
They were-
that. Yeah, the
they were
first
very
intro. Yeah,
they were very subtle about it, but they already started hinting that that is how they're going to be approaching this, especially with valuation like this. They've got $4 billion in cash right now, sitting there. They don't have any debt maturities. I looked over their debt schedule. They're actually going to benefit from debt repayments, but then also probably some maturities in the future being rolled down when interest rates come down. One of the reasons why their net income wasn't higher, Matt, is because they got somewhat whacked on their swaps, on their interest rate swaps.
Yep.
So about 700 million was because of interest rate swaps that they had to take on, because you don't want to be in a position where the interest on the debt can basically go crazy. And then at the same time, liquid LNG prices go down. And now you end up in a scenario where you're going to go bankrupt. So I think as part of some of the secured terms that they had, they probably had to get hedges in place to mitigate any interest rate shock. And now that interest rates have come down, those hedges are actually not worth as much. But once again, it's like insurance, right? If you can't say, oh my God, I wasted money by not buying car insurance and I didn't get into an accident. You sometimes just have to bite the bullet and, pay for the insurance. So that's one of the reasons why. And I think it's actually recorded. See, their interest rate, the funny thing is their interest expense is not that high, which is kind of, yeah.
Yeah, but here you see the 774 million.
Yeah.
But yeah, that's why a lot of the EBITDA shows up as kind of, because you get 1.7 from operations, and then you do have some income from the cash, then you have the expense, and then you're seeing the gain and impacts on interest rate swaps, etc. Because you think, anyway.
Wait, is it a gain on interest side, or is it the other way? It's not a gain, right?
I thought it was a negative.
I thought it was negative too.
Maybe I'm wrong.
No. Let's dig deeper into this. Why did it say positive? Gain on interest rate swaps. I think they have to subtract this.
I think you have to subtract it because it's from. No, it shows up as expenses as show up in parentheses, so it's positive.
Look at hold on a second. I thought it was negative. I mean, dude.
Net income. I thought it was negative as well. Let's see, net income. Gain on derivatives. Here you go.
Yeah.
So they had to get rid of that. So operating activities, gain on derivatives. It shows up as a positive in GAAP net income.
Ah, gotcha.
Right,
Okay.
because it's a derivative, but they don't actually get it in terms of cash, right?
Got it. Yeah.
Because it's like me holding a covered call that goes past, right? It shows up as a negative, but technically I didn't lose any money. But in a mark-to-market accounting, remember how all that crap works. But But one thing I think people don't really recognize, they're already paying a dividend. So for you guys that are holding the stock as of next Monday
really
or Tuesday, it's very small. Yeah, but it just goes to show you that these guys, people are probably sitting here like, this company is garbage. How could Matt and Chris have gotten us into this? But, I always bought this for the long term. I didn't buy it for it going from $24, which is when I first started buying it, to $50 the next. I thought that there could be a chance, but a very small chance that it could do that. But I'm looking at this from these guys, and I need to update my graphics that I made for my Seeking Alpha post, as well as just in general. These guys had about 100, if I remember correctly, 105. Let me just double check, of MTPA kind of in the wings, of which the excess capacity of that was supposed to be, 104.4, of which the excess capacity was supposed to be 143.8 if you'd included all the excess. Maybe that's more, maybe, and then plus with the Plaquemine phase 3, which was not included in this original 100 MTPA of FERC capacity. It's going to end up being way north of that. It's probably going to be another 30 MTPA. So you could be looking at 170 MTPA, which is almost double the current state of Qatar. So it's like you think about it in that perspective of where this potentially might go. And
I mean,
generally, before I get back to you, generally, each MTPA of export capacity, at least in kind of normal benchmarking perspective, sells for about $750 million to $1 billion on market cap. So if you're talking about, let's just say, 150 MTPA of export capacity, then 150 times your 0.75, that gets you to 112-ish billion dollar market cap to 150 billion-ish market cap in the long term. Now, sometimes it's going to be below that when, as Chris noted, the margins aren't favorable between Europe and the US. But when things are extremely favorable, like what we saw in 2022, and do we get to that point again? I don't know. But it just doesn't make sense. And another thing I wanted to point out, this 41.3% return on equity that you and I talked about as well is like insane.
Yeah. This thing is going to be printing a ton of cash, man. And they're probably going to utilize that cash to buy back shares. You know, if not buy back shares, then do massive dividends. I think even like recent, like earning, what are they called? Analyst projections about $20 as a price target for these guys in the short term. So I'm like, you know, all right. This was interesting also, you know, the amount of spot cargoes that they're going to be selling for the next 2 years before this thing gets into its spa deals. It's freaking insane. You know?
Yeah, I mean, let's look at this. Greater than 550 cargoes estimated to be produced during construction and startup of the facility across both phase 1 and phase 2. So keep in mind, when they're talking about these 550 cargoes, they're getting that at the expanded rate of the $8.97 or $7.28. They're talking about, these higher margins versus if you were to talk about where Calcasieu Pass is eventually going to go to, it might be $3.85, which is still great, right? The fact that people are like, oh, we're not going to get if you're talking about, and this is where it gets back to when you're comparing Next Decade, you're comparing Venture Global, you're comparing Cheniere. It's like Cheniere is going to be operating more off of this because Cheniere always has spas, right? So they might have a few spot cargoes here and there where you get $7 to $8, $9, or in the case of 2023, $13, $14. But in all reality, your contracted cargoes are doing absolutely phenomenal in this respect. And if you're able to kind of get some decent contracts at $3.85.
I remember this is at Calcasieu, not at Plaquemines. Plaquemines, if you go to there, they're going to be, look at all the spot that they have. The only cargoes that they have are those 18, 18, 18, and 24. So that 27 to 32, 40 to 46 and 7, that's going to be all spot. Yep. You know? So that is a crazy amount of spot that's going to be sold this year. Now, the challenge is if spot prices come down significantly, then, it's going to be a challenging year. But if spot is not going to be coming down and spot could stay relatively high, that is a lot of money that's going to be coming their way.
Yeah.
The only challenge is Henry Hub has been going up and TTF is coming down. So right now you look at the spot price, it's about $9. Did you notice that?
Mm-hmm. The difference between the two. Yeah, I mean, it really depends. I know right now it's kind of at a point where, and I think that they, in the call today, if you remind me, Chris, I think they talked about how they think it's going to be bottoming here. And when they gave the forecast of the 6.8 to 7.4 in EBITDA, you had a couple of the analysts, which is also why I think some bit of the stock came down a little bit, is analysts were saying, hey, we were expecting to see 10 billion. Right. And the reason why they were expecting to see 10 billion was, one, I think they might not have accounted a little bit for the ramp up in Q1 and Q2, which I think is kind of premature. But then second, I think they were expecting to see $10, $11, $12 for some of the Plaquemine. But I think depending on what you stated, Chris, I mean, if we see a bottoming at $7, $8, of margin for each unit sold, then in reality that could be the bottom price of the EBITDA range of 6.8 or whatever billion. But if it starts going back up to 10, 11, 12, like you were kind of talking about, then that's where you might really start to see the huge benefit of being unburdened and being on commissioning rather than being contracted, rather than burdened is maybe a better term.
So someone keeps asking, why is Cheniere doing so well and prices are Cheniere has long-term spas. The goal of these guys is to eventually get to that level also, but in the meantime, they have a lot more exposure to spot prices. Okay, so imagine right now think of a toll bridge, right, where you have 3 lanes and all 3 lanes are being utilized, and you have a fixed amount that's basically always getting in, so you're tolling. That is what Cheniere is doing. These guys are saying, let's have 3 lanes for tolls, and then have 1 lane where we do the selling, and we do it based on like current market dynamics, because there are times where the market dynamics can be really, really favorable in your favor, and you can generate a ton of money. So that is what they're doing. Eventually, they are likely to get into more fixed stuff and only have a marginal amount of spot, right?
Yep.
But while they're doing their commissioning cargoes, they are mostly going to be selling at spot. They can't do fixed contracts during the commissioning phase. So that's your answer.
But yeah, to give some color on that as well. So they talked about this with good detail. So by April 15th, they're going to be moving the original Calcasieu Pass project to basically be the contracted spas that they have. So that'll be a little bit more reliable. But you can see here this blue line, and this is right-hand side, right, on this graphic. This blue line shows the 39.25 MTPA that they have contracted, and basically will eventually get in terms of everything that's been contracted. That's Calcasieu Pass 1, 2, Plaquemines 1 and 2. And so that's what this 39.25 is. And this purple demonstrates basically what they've actually delivered to date, and or where they will have delivered to date. And so this includes the excess capacity, right? Because if you look at the actual nameplates of these 2 facilities, it should only be 30 MTPA. So you can see they've already delivered above nameplate for both the original Calcasieu project as well as Plaquemine, and will continue to increase, which is when you go to this slide, you see this ramping up here of all the different volumes. And so why is this important? So it goes back to what Chris was talking about. Of the 50 MTPA that will eventually be nameplate, only 39.25 will be contracted. So that means smooth revenue, right? Like gas prices could go to 0, right? Effectively, or go to $1 billion, or let's just be realistic, $20. And with that, this would still be a very long stream of revenue. However, anything of capacity where this purple line goes above this blue is to a place where you're reliant on spot prices, which in the case of the Ukraine crisis in 2022, favorable. In the cases where we're at now, where you're seeing that turnover in the EU TTF price, not favorable right now for potentially, or at least getting less favorable than what it was in 2022, 2023. Is it still favorable? Yes, it's still favorable to sell at spot prices, but it's about that contract stability. And the problem with a lot of this is in order to build these big facilities, you need that stability in the contracts to be able to build them. The benefit going forward is, and this is where on the conversation they were talking about, and why Chris and I are so bullish potentially, we're talking about 35 to 40 MTPA of the current in place spot contracts, right? But in the long term, we're talking about potentially exporting up to 150 MTPA. The benefit of being Venture Global is they're going to have their own ships where they can do spot contracts and be able to ship back and forth. Now, this isn't necessarily something that's going to happen in 25 or even 26 or even 27, but by 2032, 2033, you should be having over 100 MTPA easily. Now, what they talked about very specifically on the call today was once they get Calcasieu Pass 2, which is supposed to start getting commissioned in 2027 timeframe, maybe even late 26. Maybe let's scroll down to the CP2 project. You can see that, towards the latter half of 26, you'll start to potentially get it into, the latter half of 27 should be getting first LNG from that. So maybe it'll end up being early 26. I think they're very conservative on some of these graphics, just to be sure. But if that's the case and they start getting these trains online in late 26, 27, well, they only have half of the current capacity for this particular project under spot contracts. Now, if they're able to pay for it on their own, which they're getting enough money through the door now where they're going to be able to generate $6 to $8 billion in EBITDA, maybe even north of 10, depending on spot prices, then do they really need to go to the banks to be reliant upon debt to be able to pay, or can they just pay out of pocket? Now, they went and paid some money out of pocket and went and got more debt in this potential quarter to be able to pay for some of the CP2 stuff, which I think was about $4 billion this quarter, if I remember, Chris, or maybe it was $4 billion the whole year. I think it was $9 billion in total capex for fiscal year 24, but $4 billion specifically for CP2 or something like that.
Yeah, I think they spent about $4. I don't know, man. It's because they bought a lot of equipment. Yeah. Like their expansion plans are insane right now. So I looked at like all their expenses, and one of the key expenses that they have is just the amount of like the trains that they're getting fabricated right now. Like literally, this is such a fast moving train. They've got things that are in fabrication for projects that haven't even hit FID yet.
Yeah,
because that is the level of speed.
They're waiting on FERC. These guys are moving faster. So generally people wait, but they're like, we're just going to build it. And so really they're waiting on the EIS, the environmental investigation study, to basically get authorization, FERC approval, and they're ready to go. They're already building the trains, right? So by the time this actually comes around for phase one, you're seeing the FID process for phase one probably in the middle of probably next 2 or 3 months, and then phase two to be the following year, and then hopefully phase one will start to come online in 27. But that's the thing, is they're talking about all of Plaquemine phase two trains arriving within the next month or two based off the call, and then they have the other 18 trains or whatever for phase one already starting to be manufactured, like you stated, which is this line here, complete. They've already basically secured that and are getting them fabricated. And really, it's just waiting upon the FERC news to be able to get it done and move forward. So they're moving super fast.
Yeah. Did they talk about anything else? Go down one slide.
They talked about the Plaquemine expansion.
So this is the brownfield expansion that they spoke about. Was it today? Yeah. This was the brownfield expansion that they spoke about today. Because they did so well, they're already in the process of expanding this damn thing. I was like, God damn. And this is where the cost of the expansion may not be nearly as much as, a whole new thing. So this is very, very value accretive for anyone looking long term. If your time horizon is like 20, 30 plus, these guys are going to be generating so much freaking cash.
Mm-hmm. They basically stated that they feel confident that they could undermine based off of this, because you think about it, they designed it and sanctioned the project based off of the original 20 MTPA, which will end up being 27 after, being able to go 40% above. But they basically stated they were able to find the space to do this expansion. And because you're utilizing so much of the original project, the cost to deliver is going to be so huge that the margins that you're going to be able to get from liquefaction and what they've been able to lock in are going to be huge. They're going to be able to undercut everybody, they basically said. And so when it comes to
the other thing that
contracts rolling off, they're going to be able to compete better than anybody else, because people are like, we can't compete. We can't make money off of that. The other 8 or 9 facilities can't make money off of that, but these guys might be able to.
So, yeah, that was a very surprising thing I heard on the call when he was talking about we'll just dominate the market and basically undercut everyone and basically just take this whole thing because we have the ability to do that. And I'm like, that means that future FIDs might not go through because financing may not come through because the spa deals that they're able to sign. Because from what I could tell, the other spa deals are at least $3 something. These guys are like, we'll do it for fucking two. I'm like, whoa, that's a 30% discount. And the thing is, now if they end up actually showing that they can do it reliably, which they should be able to starting next month, dude, every other project that's like in the works right now is going to have to reevaluate their unit economics. In which case, now funding may end up drying up for a lot of their expansion projects, because at that point it's going to be like, holy crap, the world is awash in this stuff. So yeah.
Yeah, this is what Chris was talking about with respect to prices kind of coming down a little bit. It's even being exacerbated from here, but you're seeing Henry Hub kind of going up and into the right. And this is, I assume, with the 15% addition to the price, I assume, maybe a little bit more with like, I don't know, liquefaction costs and stuff like that. I don't really know exactly where that $5.21 is coming from.
I think that might actually come down because the thing is, like with the Trump admin right now, with the whole drill baby drill, that may end up the challenge for us right now is if you look at the margins between the two, 1380 and $5.21 with, I think they actually explained it, like how much it costs to liquefy and then to do the transport and everything else. And because they can cut the cost, cut out a lot of middlemen, they're going to be able to do it at a low price. But the challenge is if, let's say, Henry Hub were to drop down to, let's say, $3, which is very possible because especially if you drill a lot of LNG and the price of JKM and TTF stay relatively the same, you're looking at another extra couple of dollars per MMBTU.
Which is beautiful.
Which is beautiful. Like the biggest thing is the AI data centers right now are eating up so much of the demand for nat gas. The nat gas prices here on Henry Hub are staying around $4 when the Biden administration had done their freeze on export licenses. And some of those things, I think that caused natural gas to kind of pull back. But I don't know, with drill baby drill, we'll see what happens.
We'll see. Yeah, I mean, this is forecasted for the year, right? So who knows what it ends up being? Will it kind of trend down, or do we end up at the end of the year at $5.21? Who knows? But this is the thing that I talked about expensively, and going back to what Chris was talking about, where they undercut everybody. These are the contracted volumes that are expected to expire globally. So if you look, this is all MTPA. So we're talking about pretty much the country of Qatar, which is number 2 or number 3 behind Australia and the United States in terms of export capacity at the moment. But basically that being able to be renegotiated in the next 4 or 5 years when a lot of these projects are coming online. So the ability to undercut if they have the appropriate financing in place and project in pace.
Someone is asking about their ships. They already started taking delivery of ships. Ships are already coming around, and they're already utilizing those ships to export. They actually had one today in their presentation where they were already loading cargoes and utilizing them. So I think they have a few more that are in delivery. They also have 2 that they've leased out. So
Yep. So talked about $1.2 billion in the LNG assets in 2024. LNG vessels, $4 billion this year at CP2. And then midstream, I wasn't sure if that was the regasification plants or what exactly the midstream assets were, but that's something I'm going to try to dive deeper into. But I think this is what's important, right? I mean, when you're talking about producing, let's just say upwards of $6, $7, $8 billion of EBITDA next year, where are you going to put all that money, right? You only have $29 billion only. It's a lot of money, but you have $29 billion worth of debt and you're chipping away at it. And then it's only going to get exacerbated as you bring on CP2. And so, yeah, CP2 is going to cost a lot of money. You're going to have to bring that on within the next 2 to 3 years, but you've already started getting some of that investment in, and hopefully in the next year or so, the amount of EBITDA that this company will be generating we'll be able to pay down a lot of that debt, and then also focus on potential share buybacks and potential dividend raises, etc. I don't expect them to prioritize that. I want them to get to a place where debt is more manageable and they can kind of keep debt maybe in the 15 to $20 billion range as they continue to bring on, CP2, then eventually Delta, and then CP3 projects. But it just goes to show you that, with everything that's kind of going on, these guys are going to be able to generate a decent amount of income and a decent amount of EBITDA. And with that, I think the debt should be manageable. Especially if you're investing, you think about it, this was probably a big year for them, bringing on Plaquemine and bringing on CP2. If you're focusing on right now where they're at today, that was $9 billion worth of CapEx in fiscal year 24. I don't think going to be that expansive going forward. I think it'll probably be at a much even pace. And even if it does stay at the $8 or $9 billion range for quite some time, they're at least making about $7 billion in EBITDA. And then next year, potentially longer out in term, they're going to be making 8, 9, 10. And then eventually, once CP2 comes online, that's a huge project. That is literally going to increase the amount of EBITDA by probably an additional bring it to 15 to $20 billion of EBITDA per annum. So you're looking at pretty much what the Plaquemine project has done, and then add that pretty much back to the bottom line. So you went from $2 billion in EBITDA for fiscal year 24. They're forecasting $7 billion. So expect basically going from $8 billion in EBITDA to 13. And then if you have upside, any sort of spot prices or anything of the like, it's going to be pretty big, man. I don't think people are fully recognizing what that potentially might be. That's additional 28 MTPA. And then they announced the Plaquemine project, which should start kind of getting sanctioned, the phase 3 project, which should be sanctioned in 27. So that should be online towards the latter half of the decade. So you start thinking, you're going to have a lot. You're going to have a lot on your hands. Like, you're going to have 67.6 basically by the end of 27, 67.6 MTPA online. And right now, fiscal year 24, they were at 12.4. So you're basically increasing the amount of export capacity by, I'm not good with math, Chris, so correct me if I'm wrong here, about 4 to 5x compared to where they were in fiscal year 24. And so I'd anticipate that 2 point something EBITDA that you're seeing, and this is in a poorer environment, should grow to at least 13 billion in EBITDA by 2027.
At 13 billion EBITDA, like I said, 10 with a multiple of 10 minus probably by then, because they're looking about 20 billion in CapEx for that. So,
and then there's 2 projects after that. And then there's 40, an expansion project. It's like, come on, man. Like, if you are, I don't know if you'll necessarily get the price to EBITDA of 10 with this, but you could. So in a good year, I wouldn't be surprised they're able to make.
The future is bright for these guys, man. Like, we'll look back 2035 and be like, holy shit, these guys are like the Exxon Mobil of nat gas exporting,
There's one of two things that are happening. This is either a flamingly good price, or Chris and I are missing something completely obvious that all the other analysts are not. And I just don't see it.
All the other analysts are rating this thing at a much higher multiple right now. I think we just saw, who was it that just came out? Price target. I think someone just hit a price target about 20, like literally today. I don't know who it was. I just saw it, but everyone is saying the price target should be at least $18 to $20. And that's today's thing, not a. Yeah, it's nuts.
So Mr. Patel, did you buy it all today?
I did buy more. I bought a little bit too fucking early, man. I should have waited a little bit, just let it stable, but it's fine. Whatever. If my goal is, 10 years, I don't really care.
Yeah. I think I bought at 11. I think I bought at $10.10. And then I think I bought pretty much at $9 as well.
Look at this. Goldman gave a price target about $29 on these guys. I mean, dude, it's I wish I had more money to buy. I'm gonna have to talk to the wife and be like, can we just delay the house purchasing for maybe like
So
another
$29 at a 2.4 share count is $70 billion market cap.
Yeah.
We are trading at currently 22.
Yeah.
So, I mean, and they initiated that today,
2 weeks ago.
2 weeks ago. Maybe they'll reiterate it. Maybe they'll reiterate it.
Yeah.
Okay.
So one interesting thing to look at is that little chyron at the bottom, the $1 MMBTU charge and fixed liquefaction fees will impact consolidated EBITDA by 600 to 675. So basically, if you're looking at what did they target for, I wonder what they targeted for their EBITDA like multiple. Like what price did they use for Henry Hub like to get to that amount? Let's do a reverse to see what they use. So they said 6.8 to 7.4, right? So what is their MMBTU average? Do they think that they're
that
going to get?
was, I think they said between 7 and 8. Adjusted EBITDA range for $4. They said it on the call a lot. I'm just trying to find it here.
Is there a transcript of the call? We gotta look it up. See, this is where we should show everyone Notebook LM and actually do a live thing. Do you want to show people that or no? Or you can upload their transcript. I don't know if there's a transcript available for it. Oh, you already ran it.
Yeah. What assumption did management use to forecast the 2025 guidance? Let's see if it's smart enough. Let's see. Based on the information and sources, the achievement of commercial agriculture pass, ramp up of Plaquemines, the dynamic of Henry Hub, TTF, etc. But it doesn't say 7 to 8.
No. So just ask it literally, like what's the target Henry Hub prices are they using to base their EBITDA?
Domestic is key driver. They do not explicitly state the target 6 to 8 billion, 6.8 billion to 7.4. They do regard assumed price of $4 as an illustrative purposes for the LNG net spread.
Ask them, ask it. Yeah, I was going to ask, like, what about TTF? Because TTF and JKM are about, yeah.
I think what I didn't upload the actual transcript or the webcast.
Yeah.
And that would probably be able to provide a little bit more color because I don't think that they explain it well on the.
Yeah, I think they did it on the They actually did go through it on the transcript. So let me see. Venture Global Earnings Transcript. Oh, here it is. I found the transcript. Yeah, here's if you want to just load this.
Yeah.
Let me just
Interesting. That might be it. I might have lost you. Where are you? That's me. Here we go.
I found the website that has it. Let me see. Earnings call. They have a listen, company details. Even if someone uploaded to YouTube. Earnings transcript. Well, here's the earnings transcript itself. So let
Where
me
are you
just
putting it? In WhatsApp?
Yeah, I'll put it on WhatsApp for you.
Okay.
You might have to just copy and edit paste on there.
People want to know why I like using what's it? It's right there. Let's see. Where is my notebook?
So sources mention the average. There you go.
Oops.
You just use StreamYard. Yeah.
Whoops.
I was gonna
Womp womp.
Yeah.
Now we're gonna have people in the background.
Hmm.
I thought you said you put it on.
Yeah, it's on WhatsApp. I just sent it to you. Oh no, that's StreamYard
That's the
link.
StreamYard.
Sorry.
Yeah. Sorry. I
Sorry,
didn't. I'm not the. Yeah. Sorry.
Culprit.
Yeah, I'm not the
There
culprit.
you go.
There you go.
There you go.
I was like, what the heck? Thought I was having a seizure. All right. Now, what do you want me to ask?
Now ask it like what would be like do a breakdown. Like ask it what the breakdown of TTF pricing for their EBITDA targets.
One of the sources includes a chart for TTF. So that's the $13 to $13.80 that they used. And that was for April through December, the one that they showed. And then it says context, the average TTF was in 2024 was $10.89. So
Mark, because it ramped up. If you look at the chart, it went from I think like 8 or 9 to eventually to 15. So it averaged it out. So right there, they offer a range of fixed liquefaction fee of $7 to $8 per MMBTU. So that's probably what it is. It's about $7 to $8, right? So
and that's what they talked about in the call.
Yeah. So basically, if there's compression between the two, so if Henry Hub goes to 5 and TTF goes to 12, then that'll compress, right, to 7, right? No, it would be 5 minus, it would be 7. So let's say it goes the opposite direction where basically Henry Hub goes down to 3 and TTF stays at like, let's say 13, then it would be like 10. So they would actually generate more. So then that would increase their EBITDA for the year, EBITDA target for the year.
Yeah. So they're contracted. So keep in mind, this is the blue.
Yeah.
That's $8. So the dark blue is $8. This light blue is spot cargoes. And then now they're going to contracted cargoes starting in Q1 of 25, where they're basically getting $3.85. So it goes down. And the potential excess cargoes, I'm not really sure what price they're getting for those.
I mean, it says right there, maybe the $9, probably. I doubt it. Yeah, whatever. So the point is, I think they're going to settle at about $7 or $8 per MMBTU.
It says it somewhere. I'm just trying to remember where.
Yeah,
but you kind of see it what their assumptions are. I mean, they have the graph that kind of shows that, and plus they have kind of the 2025 estimates, and but then start to think about it. It's like, so if they're using $7 to $8 for those cargoes, then you add another 28. Then another 18 for this expansion project. Like you start to realize like these guys are going to potentially put some real volume.
Yeah.
In the long term. Do you want to answer any of these chat questions? I haven't been paying attention as I've been going through the pack.
I tried answering a couple here and there. So let's see.
I have some people asking about the general market. I personally think Chris alluded to it in the beginning. He thinks that it potentially is going to go to. I'm more on and correct me if I misquoted you there. I think that I'm with Tom Lee. I think that with the rollbacks happening, I was expecting rollbacks to happening and being pushed. I think honestly, it's probably a short-term bottom here. I don't really see a reason for it to go much more down than 10%. Maybe we hit 12 to 13% down on the NASDAQ and maybe 10% on the SPY, but I just don't really see it right now. But if it did happen, I wouldn't mind. I'm constantly buying. I told Chris, I have a decent chunk of change coming in next week. So I was hoping to pay myself back because I'm closing on another property next week. But if I can't and I need to, keep keep buying stocks, that's fine too. So
I have money set aside for taxes and for a down payment on a house, but I'm thinking like, hey, you know what? Maybe because the thing is like none of the houses that we're finding right now are appealing, and the ones that are out there are kind of expensive. So I might just talk to my wife, be like, listen, let's just buy some venture global, and you know what? If everything works out, we'll buy a mansion. Otherwise, we've got the apartment fine, running just fine. You know.
yeah,
So we'll see. I don't think it. The wife is good because she is a degenerate gambler, but maybe not to that extent. So we'll see.
yeah,
You know, I'm thinking of selling some other stuff that I still have conviction in, but maybe I'll just trim a little bit to buy more venture global stock. You know, and basically ride the recovery because I think eventually the market's going to wake up to this, and when it does, it's like, oh my god, like how do we miss this? So you
yeah.
know, I kind of want to average down my holdings and just keep at it. I wish I had a little bit more liquidity right now. I could pull some strings and get liquidity, but I don't know.
Yeah.
Yeah.
Yeah, man. I mean, I personally am buying. I'll continue to buy. I'm thinking about, at least for right now, I have a lot of buys on a lot of stuff that whenever a paycheck comes in, it's a couple $100 here, a couple $100 there.
Yeah.
At least for the short term, I'm thinking about reallocating a lot of that. Not a lot of it, but a large portion of it to venture global. Because I kind of spread it evenly right now.
Yeah.
Amongst Next Decade, amongst Rocket Lab, amongst Bitcoin, and so to be very honest, man, like I find, and I would love, I very much encourage somebody to find a reason why long-term venture global will not be north of $100 billion market cap at some point.
Yeah. And please let us know if you can find that because I would
Because
be very
I
curious.
can't, right? I mean, even if it goes to 80 billion, right? I mean, that was kind of always like my downside was like, even if it goes to 80 billion, but I just don't foresee a reason why.
The one thing though, Matt, and I think everyone in the chat, hopefully y'all realize, when you look at the stock price and the market cap, they're two different things. So even if, let's say, these guys get to an $80 billion market cap, which means that in current outstanding shares, that's $40 a share. If they start to do share buybacks and they're generating this much cash flow and they're doing share buybacks, that means that the stock price can actually explode. So your total return could be way more, right? So let's say right now you look at something like AutoZone, right? The amount of shares that they buy back, their EPS grows significantly in comparison. So even if the market cap only goes up by like 10, 20%, the stock price can actually double. Right. So right now, if you look at the stock price of Venture Global, it's like $9, which is a $22 billion market cap, but that's with 2-point-something billion shares outstanding. If these guys start to generate significant amount of free cash flow and that money gets put into share buybacks, that means that it's super value accretive. And this thing could be one of the most undervalued things. This thing could go to like 200,
Yep.
Like
if they prioritize, like I don't think they're going to do this, but let's just say they prioritized half of the EBITDA that comes in next year to buybacks. It's like that'll be let's just say $4 billion, $3 billion even. That's 15% of the float.
Yeah. Yeah.
So in that respect, like, and the reason when Chris brought up AutoZone, I have this down to a T. So I did this a year ago, so the numbers are probably off, but the magnitude is right. So AutoZone is up about 50x or about 5,000% from early 2000s. It's not that the earnings went up crazy, right? Actually, the earnings have only gone up about, I'm going to get the numbers wrong. It could be 600 or 800%. The earnings went up 6 or 8x, but it's actually was 6x. So the earnings went up 6x. The reason why the stock isn't up 600%, it's up 5,000% is because, yes, earnings went up 6x, but they bought back 87.5% of the shares outstanding. So you have 1/8 of the initial share count. So what does that mean? 600% times 8 is 4,800%. That's your 50,000. So when it comes back to how these share buybacks work in change, that's how you get to the point where you can have massive amounts of growth. So from the
Yeah.
early 2000s, you had a 6x in total profit, and you bought back 87.5% of the float. So
Yep.
that's what people are speculating might happen with PayPal right now. I was having a great lunch. I had lunch with Roy today. We talked for about almost 3 hours. We both had to leave at about 3:15. Overstayed my lunch. Should have been at the office, but I came home and I finished up the office. But that's the hope. Is what PayPal is. I think that they're hoping to potentially buy back $5 billion of stock or something stupid. So yeah,
If you look at PayPal shares outstanding, they've literally gone cannibal. You know, let me just show you. Hold on, stock. So even if they don't necessarily grow their earnings, I mean, like their earnings, like total on a per share basis, their earnings are going to grow significantly. So if you look at this income, let me look at their share. Yeah, look at this right here. Shares outstanding. It's literally gone down like this, buying back tremendous amount of shares. So look at the share count right here. So it's literally 6% of the float they're buying back per year right now.
yeah.
That's freaking insane.
Man, I'm
That
messaging
is
StreamYard,
insane.
man. StreamYard, like for me to be paying $400 a year to use this fucking software, sorry for like just being blunt, and to have and Amit has this problem too. So I know it's not just me. The screen just goes black for random reasons. No point. So what you're sharing right now, people can't see.
Really?
Yep.
Oh,
I can see it. I can see it beautifully. But it does
yeah.
for some reason when you're sharing it, and some maybe if you reshare it, it'll show again. But like the fact that it does that, and I'm paying $400 a year for this fucking software.
It
And
says
then
a
at the
new
same
beta feature. What is this? What is
I don't
that?
know what it is, man. I
There's
don't know what it
something you
is.
have to click. Yeah.
It was shit. Wasn't
Yeah.
it showing this whole time? I didn't.
Let me try. Hold on. Shares outstanding. Is it because like we're streaming to Twitter also? Could that be it?
I doubt it.
No. But here, this is literally PayPal and the amount of shares that they're buying back. Look at this. Insane. Freaking insane.
So if it's not showing, it went from basically 0 buybacks to 6% per quarter, or is that per
Yeah.
year?
Per year. They do it even what are they called? Amit was having same issue all day. Can't see it on StreamYard. Can't see Chris's screen either.
Yeah.
I don't know. It's blank on our side. That's so
I
weird.
wonder if when it actually publishes the video, people can see it.
I hope so. It's like that on Twitch. Still see black screen. Can you guys see it? No? YouTube, a lot of streamers have done. Let me look at it. Hold on. Don't do anything. Let me see on
Yeah, maybe.
let me log in.
Okay, now they can. I just had to maybe minimize it, but it literally was on the same setting before I minimized it and brought it back up.
Yeah. Hold on. 1 second.
It's stupid. Like it's not like I changed anything. I literally clicked to, and I bet if I did it again,
It's so funny when we it did happen. It's actually was like that. When we were sharing the slides though, that actually did show up. So
good,
at least that's
good. I've been trying to keep track because people said earlier when you were sharing the TTF initially when the decline from $60 to $30.
Yeah.
And that's viewed differently. That's like euros, and it's also megawatt hours, right? They don't show it in MMBTU for some reason, so you can't compare the $13 we're talking about in MMBTU, $14 MMBTU compared to that $30. They do correlate, but they're different units. So that $30 that Chris was showing earlier correlates to that $14-$14. Just to different units and stuff like that. But but anyway, I personally bought more today. I think it's a great opportunity. I think it just really depends, though, right? And this is where it gets back to, unfortunately, as people that are in the public of, demonstrating and talking about something like this, about how bullish we are. I know that I'm holding these shares till 2032. I'm probably unless something drastic changes and I was swindled and they're pulling wool over my eyes and it's complete bullshit. I'm holding these shares till 2032. So it
Yeah.
doesn't make sense to me. It doesn't make sense for somebody else who's sitting there being like, I want money tomorrow, or I want money in the next month or 2 months or even a year or 2 years to potentially
Yeah.
be like, oh, like this is where I should put my money, because it could trade sideways from here, or it could continue to go to $8, $7. Who knows? Do I think it's going to go to $7, $8? No, but I also didn't think it was going to go below $14. So, and here we are, 40% less than $14. So,
Can I ask you something? Have you been to like Walmart or Kroger or anything? And these Pokemon cards, people are just, dude, I've gone to this machine about 8 times and it's always sold out.
I've
Like
tried to
the
go to
Pokemon
Target
vending
and stuff,
machine.
and I never see any cards or anything there.
Yeah. It's nuts, dude. Uh, Whatever.
Yeah. But yeah, any other positions you're buying, or just VG, or
Google, man. Google held up
Google?
really strong today.
Yeah.
Entire market was down like multiple percent. Google was like, yeah, I'm okay. I'm already pretty I'm pretty much value at this point. So there's not much to go. So Google was a good one. I don't know, man. I'm trying to figure out this whole Trump thing to see like at what point will the administration act. I thought I saw some glimpses of some pullback today where two things, like number one, this whole pause on USMCA, that thing like was one, and another thing that I saw was Trump actually came out and said, hey, maybe we don't want to fire everyone, maybe we want to keep some good people too. Did you see that like interaction?
No, I did not.
Yeah.
Unfortunately.
Yeah. And Trump also said like he's not looking at the stock market right now, which pretty much means he's looking at the stock market. So I wonder if he's gonna roll. I wouldn't say roll things back because I don't think he'll roll anything back, but I think he might actually just, be a little bit more sanguine on how he approaches things. Because the last thing you want to do is deal with pretty much a giant recession that's led by crazy levels of sell-offs in the general market. By the way, I don't know if you saw the Energy Secretary Chris Wright and Doug Burgum, Secretary of Interior. They were actually at Plaquemines today.
I did not see that.
Yeah, they had this whole thing. Let me just pull it up.
I did see somebody. I wasn't sure if that was real or not. I saw somebody say something about it, and I was like, "Is this a joke because the stock's down 35%, or is this a?"
Yeah. No, let me just share my screen and I'll show you. And even the governor of Louisiana was there. So hold on, there it is.
Hey, Louisiana, I'm sitting on the banks of the mighty Mississippi with Venture Global's unbelievable LNG facility behind us. It's the largest construction project going on in the United States right now. And guess what? They just announced a $18 billion expansion right here in Louisiana. What does that mean? More jobs, more tax revenue for Louisiana. And it's built on all of the great work we did last year by focusing on crime, education, and the economy. And you know what they're banking on? They're banking that you're going to go out and vote for Amendment number 2, which is going to greatly improve our business.
Great. But yeah, this was the actual stream. Nope, no volume because they're actually playing like. Hold on, there we go.
This is the entire United States. The flexible incremental capacity will position us to respond rapidly to market growth signals, support U.S. allies around the world so they can buy U.S. manufactured LNG instead of from Russia in the Middle East. In fact, over on the Mississippi River behind us is a vessel loading American LNG to send to our allies in Germany. To date, Calcasieu Pass and Plaquemines have sent over 60 cargoes of LNG to Germany, including during critical phases earlier in the war with Russia. We're able to confidently make plans to deploy more capital with a renewed strength and confidence in the U.S. regulatory environment under this administration. And our cabinet secretaries and our government are going to make sure that happens. We are incredibly grateful for the Trump administration's unwavering commitment to building out our nation's critical energy infrastructure and supporting U.S. LNG growth and American energy jobs. under what we believe will be and is now one of the best regulatory and policy environments in decades. We continue to help our allies diversify their energy supply, create American energy jobs, and lower energy prices. And build, baby, build. We are excited to keep growing our business right here in Louisiana. Well, now one of the key leaders making this happen is our governor. I'd like to introduce the great governor of Louisiana.
Constellation Energy, which is one of the largest electrical providers in the Northeast. And he said the most important energy commodity in the world today is a reliable and clean electric megawatt, just because of the difficulty of replacing it and the need for it. And I want you to know something, that as we grow our economy, it cannot be grown without the work that you all are doing. That is how important of a job that you do. And I want to thank Global Venture and each one of the workers that are out here building this unbelievable this is unbelievable. This is great. Biggest construction project. I'm going to just go ahead and say it. I believe that this is the biggest construction project in America today. That is what you being a part of is.
This guy loves his gumbo.
And the thing that makes me smile the most is that at the end of the day, Louisiana is leading not only the nation, but in the world for energy production and ability to export that energy to our friends around the globe, making sure that we create stability and peace around, because there's no one that understands. He says,
unleash the American spirit. And I see it here today with all of you. He's from the East Coast. He's a real estate developer, but instinctually, he gets energy. He knows that energy is not one sector of the economy. It's the sector of the economy that enables everything else. Everything else. I want to thank the governor of Louisiana. Look, this giant projects like this, they're not getting built in California, where I lived many years. They're not getting built in a lot of places. This takes leadership and boldness. This governor of Louisiana has allowed a flourishing in the Louisiana Gulf Coast and across the state. Louisiana today exports more LNG than every state in the United States. This is number one.
Hold on. And then this is Doug Burgum, the Secretary of Interior.
Good afternoon. What a gorgeous day we have here today. And today is a day of gratitude, and it's a day of celebration. You've heard from the great speakers up here, my friend Governor Jeff Landry. We got two amazing entrepreneurs, Mike and Bob, and the amazing Chris Wright. But we're celebrating today American innovation, American entrepreneurship, and American workers. I stand here before you humbled because I can't think of anything more patriotic, and there's no place I'd rather be than here looking at all of you, standing here among this creation that you've built. And it started with two guys that said, hey, maybe we can do something that's never been done before. Maybe we can invent a new way to think about how we want to process natural gas. Maybe we can figure out that the U.S., instead of being a net importer, is going to be a net exporter. And it was a couple of guys just sitting around a table that came up with the idea of Venture Global. And then you hear it's like, again, only in America now is going to be one of the most important and influential energy companies in the world. That happens in our country when we get the government out of the way. It happens when we cut red tape. And the National Energy Dominance Council, as President Trump has asked Chris Wright and I to lead, is exactly that. One of our pathways to energy dominance is just unleashing the incredible resources that we have in this country, getting the red tape, getting the federal government off the back of the worker, off the back of companies, and so that everybody can do the amazing work and build projects like this. And so we're celebrating that today, but I also said today is a day of gratitude, and I want to bring a message from President Trump to all of you. Because President Trump fights for all of you every day. This guy, I know everybody here, you work hard, you put in a long day, you go home, you get up and you do it the next day. He respects that. And you know what? He does that too. This guy didn't take a day off for the last 90 days before the election Then the next day he got up and he didn't take a day off. He just started jamming all the way through to January 20th. And then since January 20th, he's gotten more done than any president in the history of the United States ever has in their first month and a half. And somebody asked me, what's it like working for the president? And I said, well, it's simply going to stop wars. So when you guys go to work every day, tell yourself, you're just not doing a job building the most amazing, most technological plant on the planet, the biggest construction project in North America. You're also building world peace. And the other thing you're also doing is you're building prosperity here at home for everybody that's here. And it all starts with one thing, and that's American energy. And you're going to say it with me because on energy dominance, part of our job is cut red tape, and the other is we got to get more things flowing through those pipes heading towards Louisiana. And how are we going to do that? You know how we're going to do it is 3 words. What are we going to do? We're going to drill, baby, drill. One more time. What are we going to do? We're going to.
I'm done with the infomercial for the Trump campaign. But the point is, all the regulatory hurdles gone. These guys are going to be pretty much golden with a lot of the thing. I think the other terminals were being held up by FERC and all this other stuff. I think a lot of what we're seeing right now is just the amount of expansion that these guys are going to do under the Trump administration is going to be freaking massive. Remember, I told you when we were speaking about this a while ago, I said, I bet you these guys are trying to get as much of the construction done as possible, because once the construction is done and they're already exporting, there's really no stopping them, you know? But the thing is, if they don't do it, then there is a point where the environmentalists could scuttle this, and especially at a point where they're not generating free cash flow to like fight the to the thing. So how many like LNG terminals did we have over the last like 6 years get scuttled because of regulatory changes by the federal government, and like the amount of time it took, like 6, 7, I think 8 years sometimes just to get one of these things running. These guys have 2 that are already running, one that's going to go in expansion and the other one that's going to have like a side project, and then they're going to have Delta. Dude, I'm telling you, by 2030, before the Trump administration ends, like 2029, these guys are going to have everything running as much as possible. You know, so
well, it gets me to question, because I didn't think there was any more space for them to expand at Plaquemines, and here they have a phase 3 kind of planned out. So it's like,
dude,
how many additional projects do they have?
The thing that should shock people, they're running at 140% nameplate capacity, more than that. 140. That means that's 40% more than what they originally thought that they were gonna produce. You know, just freaking nuts.
Huge.
So
Huge
that's why it's innovation, right? And the thing is, they are innovative in that they're not using traditional liquefaction trains. They're doing modular trains that they're able to, and that's their biggest differentiating point, which is they're using these modular trains that they can stack and basically start producing without having to have these massive LNG trains being produced. So it's a completely different technology. And they're doing the manufacturing, they're doing the shipping, they're doing the regasification, you know, and they're basically extracting margin from all 3 of those things. They really want to be the next ExxonMobil of LNG.
Yeah,
know?
They really do.
So
yeah, definitely. So to give people the context, right? You're seeing these different train sets up here, and there's 2 in they set up in sets like this. So instead of one long train, which would probably be the equivalent of like one of these, they have trains that are kind of like in a specific platform, and they're like Legos almost. If I'm sharing appropriately, I don't know if people are seeing it or not.
yeah.
Oh, we got a member. Cool. Let me just double check. To see if people can see that. But yeah, the graphic kind of shows that it's a little bit more modular, as they say. They can be fabricated in a warehouse and then shipped and then directly kind of put onto the pad and installed. And you don't necessarily need to be like, because it's plug and play almost, and it kind of makes it seem easier than it really is. But because it's a little bit more plug and play, all you have to do is, depending on how you install them, you can install from top to bottom. So as you get new trains in, you add 2 more, and then you call it a day. So
yeah, it's a very different process. And the thing is, that timeline from FID to first LNG, that compression is really important because there are a lot of places that are still not compressed that much. And so literally it'll take years upon years before they generate first LNG, you know?
Yep.
So
Yeah, and
Yep.
I'd like to talk about a project that I'm doing at work that explains a lot about the speed of how fast you get stuff online, but I won't talk about that. Question for you: Do we want to? Do you want to talk about next and what we've heard, or is that a different conversation for a different day? We've already been going for an hour and 40 minutes.
I think we could finish up with next if you want to talk about it real quick.
I'm trying to decide if I've given enough time for people to soak. I would feel bad, but I'll let you go first.
Yeah. So next decade, they are a competitor and they have plans right now to expand far beyond what the original project was. One of the reasons why they're able to do that is because there's a lot of demand in the future. Okay, so if there wasn't demand for LNG future, they wouldn't necessarily have the backers to do it. Now, Total, who is a big French multinational, they came in and they basically, they did an equity ownership stake in them, but they also see that in the future how big LNG is going to be. So one of the things that we saw was this this talk of expansion beyond its original. Let me just bring it up. Next decade.
Thank you for becoming a member, my friend.
Yeah, let me just bring it up right here. So they just did an update on that. So next decade is a very large project in Texas. It's called Rio Grande LNG. So one of the things that they have is they have a huge site over there. They've been kind of stuck in regulatory limbo because of all the stuff that was happening with the Biden administration, but with the Trump administration, they're getting the backing to basically be confident enough to say, you know what, we're going to go harder. And so phase one is already under construction. So they have 3 trains under construction right now. They haven't FID'd. Did they FID 4 and 5 yet? No, right?
Mm-mm.
No. So they're working on phase 2, which is trains 4 and 5. But what's interesting is they're actually trying to do the permitting process right now for trains 6 through 8. Now, their original phase
Levy.
1 and 2. Yeah, go ahead.
I was going to say the levy, if that's what you were going to get into.
Yeah, the original plan was much, much smaller than what it is today. Today, the plan has grown exceptional, but the important thing for investors is that their stake in the future what is it called? Let me just bring it up. Their future projects is going to be much bigger, in which case now you're going to see a lot more possibilities of future revenue and future growth for these guys based on its ownership stake. So if you look at here, let me just show you the map. I wonder if they show it. So that's train 2. So this is the construction. Okay, here it is. So this was the original plan. Train 1, 2, 3, 4, and 5. These are the traditional big, really big liquefaction trains. Supposedly they have the ability to do probably 6, 7, and 8 now. I'm not sure where in this map they can expand out, but right here, train 6 is going to be right here. And then potential development site here, and then potential over here. So this is right here. So 7 and 8 permitting right there. See? So they have train 6 and train 7 and 8 can possibly be right here. So it's literally 1, 2, 3, 4, 5, 6, 7, 8.
I've heard even more than this, actually. So I've heard that they might actually do 10.
It's possible.
But I don't know if that was just talk or if that's real.
I don't know, man. If Total's willing and Mubadala and ADNOC are willing to put some money into it, why not?
The thing that we'll end on, so I don't want to go into the equity details, but the equity piece is where if anybody wants to do their due diligence, I'm reserving that for Patreon exclusively. I talked about that at length and detail when that news came out. that's where I think the big value comes in that I don't think people are fully putting place to place. And what I will say is for the people that are sitting here thinking that you can compare a MTPA of the facility capacity to Cheniere and to take that MTPA from Cheniere and compare that to Venture Global, and then take that MTPA capacity and compare that to Next Decade, you got a different thing coming, because each one of those, you might be able to get an approximate valuation based off of one MTPA. We also looked at the equity ownership. And that's kind of where I'll leave that, because Next Decade, if you'll look, at this point, they have 3 different equity ownerships depending on the train that they're going to be sanctioning. At the moment, with phase 1, there's only one equity ownership percentage that Next Decade has. But as they sanction trains 4 and 5, they're going to have a separate. And then with train 6, they're going to have a separate. And so when you look at that and you do the math, you'll realize that this announcement's actually very large. The value of phase 1, I'll say, for Next Decade is not very valuable. It's really after you get past phase 1 where the value truly comes in. And I'm very confident that when phase 1 shows up, they're not going to be using it for buybacks or dividends or anything like that. I think they're only going to be using it to be able to sanction future projects. And that's what I'll say. And I think the real value of Next Decade is, funny enough, in 2035 or beyond, really. So I'll leave that there.
Man, natural gas, bro. I told myself in 2016 I'd be like, I'm not touching energy anymore. I'm just gonna stick to other things. But the value is so freaking attractive. So, all right, man. Well, I think we can end it here. You know, I'm very bullish on Venture Global. I think they're going to generate so much free cash flow. They're going to end up buying back shares. The stock's going to go up. There might be times where things get sold off. Great times to buy. And if you have the conviction and it's a long-term deal for you, I think this is great. So, yep.
Yeah, but that's the thing. Always, just because I'm buying it today doesn't mean you should. Right? Always think about when you need the money, objectives, time horizon. Maybe you hate natural gas, you know? So, I mean, people that blindly followed me in, if they weren't thinking about the next, 10 years or so, which is why I bought into the company for Venture Global specifically, they're down 60% from the initial time that I started buying. So I'm okay. I'm not really blinking an eye at it, because what I saw in the earnings report today was actually better than I was expecting. So
feels like Palantir again.
Feels like Palantir, feels like Rocket Lab. Like, I've been here before. Like, I've ridden this donkey before, as Peter Beck always says, and I love this. I literally live for this. Like, I think this is, if anybody knows how, I mean, I've been investing for 10, actually probably closer to 11, 12 years now. Chris, you've probably been in this situation before. It's like times like this, if you are concentrating and you're actively understanding what is going on, are the times that you get set up for the next leg up in your portfolio. And I'll just be blunt. I'll speak in abnormality. So I'll say the first part. I entered the pandemic in February 2020. Yeah, February 2020 with about $450,000 net worth. And it dipped all the way down to about $280,000. And I was like, well, I just saw fucking $140,000 get lit on fire and blown up. By the end of 2021 into the beginning of 2022, I had 3x that amount. And then we obviously had 2022. And here we are today, right? And now, of course, I'm off that 2024, 2025 high in my portfolio, because Palantir's pulled back, Rocket Lab has pulled back. Well, I think Palantir will take a lot longer to get back to the 125 range, personally. But Rocket Lab, man, I still view that as something that's going to continue to explode and go up to the right. And then same thing with Venture Global and Next Decade. And so you think about the opportunities that I'm setting myself. I'm buying shares of great companies at cheap prices. Whether or not they follow through, then that's a different story. But I'm cautiously optimistic, just like I was on Rocket Lab. And I think you're not putting rockets into space. You're putting LNG plants on cement. Not a big deal. But Andy, Hail the Great. Thank you guys so much, both of you, for the 5 gifted from Hail the Great and Andy Hiker. Thank you guys.
Take care, guys.
Chris,
Always a
anything
pleasure.
else?
I hope Trump chills a little bit, man. Stop trying to fight the entire planet. You know, like I get it. I get you. You think that they're unfair, but bro, don't fight allies. Don't fight everyone.
Yeah. The only thing I hope is that it just lasts. Like I don't have all my money coming in next month or later this month, I guess.
Yeah.
So if it can happen over the course of the next 2-3 months, that would be preferred rather than this.
You know what? Since
I
we're already,
I have a very strong feeling we're going to be in a V shape.
so let me just show you something really quickly because, and maybe this is something we can just quickly go over. God, it was actually kind of long, but I think if you have a minute, let's just not a minute. Like we need 10 minutes. You think you can do 10 minutes?
I got plenty of time.
All right, so let's do this. Let's just do a quick view of Scott Bessent, who's going to give us the keys to the castle. Okay, go away.
Is the one big beautiful bill. I mean, that's what it is. The income tax rates would stay down. Tax
Sooner we can get this done.
Okay, there we go.
Look, I think that certainty, the closer we get to the tax bill expiring, the more what I would call an uncertainty tax goes up. So the sooner we can get this done, I lead something, Larry, I believe you were part of it, but it's called the Big Six. So it's myself, Kevin Hassett, the NEC director, Leader Thune, Chairman of the Senate Finance Committee, Senator Crapo, Speaker Johnson, and the Chairman of the House Finance Committee, Jason Smith. And the 6 of us are going at this every day to try to get it done as soon as possible so that there is no glitch in what's going on. Because the longer we wait, the bigger the chance that the unthinkable could happen and we could have this catastrophic tax increase. And I know that President Trump believes that one of the reasons that the 2018 midterms were unsuccessful was that it was an amazing tax bill you put together, but that it wasn't the focus in the first half of the year.
And you believe, and I know the president believes, but you believe, and I know that Glenn Hubbard believes, that with good policies, we should be able to project a 3% GDP growth baseline out over the next 10 or 20 years.
I think so. For those of you, when I used to sit out there for 35 years, I thought I knew how Washington accounting works, and I was wrong. Now that I'm inside the sausage factory, just so everyone, so we could kind of level set. CBO scoring makes Enron look conservative. I mean, it's crazy the things that they have. And when Larry and I talk about current policy scoring, that if we don't use current policy, the current CBO protocol, and this is why I think now being on the inside, we've gotten into this spending mess, into this tax mess, that the current baseline, I don't know why we're calling this extending the tax cuts. It is the current tax policy. Extending the current tax policy that gets rescored. Extending current spending, the current spending that got put in does not get rescored. So guess which is easier to do? You keep the spending going, you have the tax policy, the tax levels you have to fight for depending on when they expire. So this is why permanence is so important.
Yes, thank you for that. I think it's really, really important point. Insofar as the Big Six is concerned, what you're negotiating, you and Kevin Hassett and the House and Senate members, there will be a Trump budget and there will be a Trump tax plan that will be formally submitted, at some point in the near future.
Yeah, and Larry, as you said, so one thing we don't talk about a lot, and I think we're going to, is the tariff income. Right now we have substantial tariff income from China. That President Biden left on.
Mhm.
And if we have new tariff income, we won't be able to score that since it won't go through the legislative process. But I could tell you that could be very substantial. And if you think about when people say, oh, tariffs are a regressive tax, that, well, are they a regressive tax if you then use the income from tariffs to no tax on tips, no tax on Social Security, no tax on overtime, making auto loans tax deductible? Those four policies, which President Trump put forward during the campaign, all accrue to the bottom 50% of wage earners and working Americans. So, could you have a tariff policy that is in finances income tax cuts and real income increases for the bottom 50%? I think that'd be pretty great.
Mm-hmm. Have you ever met William McKinley? The president sends me text messages on William McKinley. I know I've been around, but I just missed him. I don't know. Perhaps you commune with him.
I don't.
Okay.
I did and anticipate.
Is they are a negotiating tactic, which involves short-term pain for average Americans, but long-term gain. And then he goes on. The second is that they might be considered sound fundamental policy. What are your thoughts with respect to these two scenarios?
Sure. So a couple of things. In terms of tariff policy, I think one thing that has become clear to me over the past decade, the past few years, and I set it out in an editorial that I wrote in The Economist, is Ricardian equivalence does not work if other countries have a very different economic and social policy. So China is exporting their policies to us. They decimated our manufacturing sector. There's a new paper out called The China Shock. And it said the communities recovered, the workers haven't. And so clearly the policy is not working for working Americans. So China, they exported their policies, and tariffs are one way to push back on this. So I do think it is good policy, and it is, I've said, and I say this because I know it's what President Trump believes. He believes three things. One, that it is a good source of revenues. Two, it protects our important industries and the employees. And three, he's added a third leg to the stool, and he uses it for negotiating.
We've talked about this a while back. The free trade theory of Ricardian equivalence is a very interesting theory, but there is no equivalence, as you just noted. I just wanted to highlight that the Chinese economic system and the Chinese political system is not equivalent to the United States. We are a free market democracy. They are an authoritarian socialist political entity.
Yeah, it's like California versus Texas.
Yeah. Okay. Well put. Okay. Very well put. And I think that's the problem when you look at the world trading system. It is unfair because it's not equivalent. Yes, foreign tariff rates are much higher than ours, but many of these countries are just not equivalent. We're not playing. It's not only a non-level playing field for tariffs, it's a non-level playing field for basic economies and basic polities. And you have to that has to be changed. The World Trade System, World Trade Organization never took that into account.
Well, it hasn't, Larry. And the only good thing that I could say about COVID was it was a beta test for what we could have if we had a large-scale economic disturbance or a hot war, and it showed us that optimal supply chains are not secure. And I think it has made us refocus on many of the aspects when you see President Trump talking about the rare earth strategic mineral, yes, I mean, I just talked about the spending is too high, and I think that, Larry, you and I have talked about it. I've seen Glenn Hubbard talk about it in ECNY seminars. But if you can change the growth trajectory, then we can grow our way out of this debt. And again, another one of the reasons that I'm sitting up here and not out there was I was afraid that 4 more years of like we just had would make it impossible to grow out of our debt, that the accumulated debt stock would be just too big, and you would have to go into a European style system, where you're working all the time just to pay off the debt. But I do think we are taking this seriously. I do think this is the last chance bar and grill to get this done. And imagine if we think about a growth trajectory, and again, back to CBO scoring. CBO scoring scores in the projections, they talk about, or they use 1.7, 1.8% baseline growth for 10 years, whether you cut taxes or raise taxes. So if we are sitting here in a year and we've just had the tax hike in history, the CBO will not change their growth projection, will not have changed it, even though I don't even want to think what growth could look like. So if we could get above 3%, if we could hold expenses in line, flat, or even if we could do the unthinkable, if we think about a kind of a naive reductionist model of government, G equals S minus T, spending minus taxes. Republicans, we like more spending, but we just want to do it slower. We like lower taxes. Democrats like higher taxes. What if the S actually held flat or went down? That'd be a pretty good story.
Sure would. You know, I saw a study, just to finish this point. And just one last point on the budget bin. Doge savings. I saw, it's interesting, a poll, a Democratic poll, my friend Mark Penn, in his poll, I was with Glenn Youngkin, governor of Virginia, the other day, and I thought he would, all these people are in a state over government layoffs, and so his Northern Virginia would probably be the area most affected. And I said, Governor, how are you handling this? How are you messaging it? And he said, we have 350,000 private sector jobs available in Virginia. My office has a portal up, and anyone can go on the portal and come and join us in the private sector. I mean, that goes to your theory, which I think President Trump has adopted, but it was your note, your idea. You want to, this has been a government-driven economy. You want to make this a private sector-driven economy. We want to, as I understand it, disempower the public federal bureaucracy and re-empower the kind of risk-taking and investment that goes along with private sector advances.
Okay, so let's just quickly go over some of the stuff that they discussed. There are some basically nuggets that he dropped in there that I think are very important. This transition from federal to private sector job creation, I like it. I think in theory it's a great thing, but that transition is going to suck, and it's going to suck hard, because at the end of the day, the government provides a crap ton of liquidity into the market. And if the government stops that liquidity coming in, that means that until new industries, and especially the private sector, picks up the slack, that means that earnings growth is definitely going to go down. So my question to you, Matt, is how long do you think that this dip is going to last? And do you think it'll impact us all the way through 2025?
Meaning that we'll be feeling the dip in latter half of 2025?
Well, no, I'm saying
Or that-
earnings wise. Earnings wise, look, Elon and co are cutting a lot of jobs. They're cutting spending. They're cutting NGOs. They're cutting contracts, all that stuff. So that is liquidity being taken out of the market. Another thing that's happening is, of course, demographics are changing, right? So you have all this illegal immigration and everything else. That's like literally dead now. So there isn't a lot of additional labor coming into the labor pool, right? That is another liquidity shock. I mean, demographics wise, it's deflation. Spending wise, it's deflation. I honestly have a feeling that by the end of next year, we're going to be like maybe sub 2, maybe sub 1 in the federal funds rate. What do you think about that?
I think it sounds good for my mortgages. But no, the thought process I'm struggling with is you were assuming that things are going to be so bad that they have to cut the Fed FFR that much in order to reverse the damage that is being done right now.
I'm not saying that it's damaging. I'm saying it's slowing things down. And it's slowing things down to the point where that's the only way forward. Because I mean, in my opinion, it's all liquidity, right? Whether it's the federal government creating dollars and giving it to people, you know, whether through a job or whether through anything, you're basically adding liquidity into the market. So by pulling back on liquidity, you're setting up for deflation, especially when the population starts shrinking. You're going to start losing inflationary pressures because the demand for goods and services is going to shrink, right? So imagine right now you have a barber who used to cut hair. He used to get, you know, like 100 people. Now only 90 people show up. That means that now you've got deflation on your hands. So that barber now is pretty much going to cut back on spending. He cuts back on spending. Another person cuts back on spending. Another person cuts back on spending. Another one. And it just kind of like flows. It's like flows downward, right? So my opinion is we're going to get a massive deflationary wave hitting us in the latter half of this year. What do you think?
I think it's deflationary. Maybe in real estate a little bit, because obviously I think that a lot of that has been exacerbated by the fact that nobody wants to move, and so when people start to get a little bit of movement in their opportunities, it might. But then again, it might, I don't know, that might have the opposite effect where you get so much ability to have cheaper interest rates again that folks, the competition heats up. So it could be the opposite effect. I don't know. I find it very hard to believe that will be no deflationary. Deflationary period.
One thing that everyone should look at is this. It's the It's the. I wish I had an easier way to show it other than this thing. The new rent index. Have you seen that before?
You've showed the rent index before, but I don't know if it's the new rent index or.
Check this out. This is super important. Right here. This is CPI for shelter, okay, which is in green, and that's been coming down, right? So it's about 4.4. New tenant rent index, which is year over year, and it leads by, you know, look at this, negative 2.4. I think this is a major problem that's coming our way, dude. I think we're going to get massive, massive deflationary waves hitting us sometime in the latter half of this year. I mean, some of it's going to be positive because it means that the Fed is going to have to cut faster. But this is a big, big thing that no one's really talking about.
I think a lot of that is off the stem of 2023 and 2024. Rents went to the fucking moon.
Yeah.
So, I mean, it's more of a normalization than a than a massive pullback, if that makes sense.
No, man. I'm telling
You
you,
think
this
it's
is the
gonna
last time
accelerate?
I think it's going to accelerate. Look at the last time something like this happened, which is like literally like the great financial crisis, you know? And there are a lot of leveraged plays right now in the real estate market. I think I saw like Invitation Homes and all these other like BlackRock or Blackstone owned property REITs that have been selling also into the market. So inventory has been spiking in a lot of parts of the country. So I think we could have deflationary shocks towards the end of the year. So
yeah, I mean, I'm seeing rents hold pretty strong here in Houston. 2023, 2024 was rough. It's actually what caused me to buy this house. I was like, you know what? If it's going to continue to be this way, I might as well just own a piece of property. And of course, I had the other house at the time before I bought this one. But you know, I honestly just think that I don't know. Maybe you're right. There is a lot of construction going on in a lot of the southern states, and what I do know for certain is that there was a lot of areas like Austin and Miami and a few places that, as work from home, I don't want to say was encouraged, but was allowed, allowed people to move to different cities and be able to work from there. And so with that, places of some of these hubs was able to skyrocket. Now, if you have some of these folks having to return back to the office, you know, you might have obviously we've seen Miami take a big hit, Brickell take a big hit, Austin has taken a big hit, but places like Houston, I don't think have taken nearly as large of a hit comparatively. So, but I could be wrong on that. I could be wrong. If you pull that up specifically for Houston, maybe it shows just that.
Yeah, no, I mean, we can look at it another time. But one of the things that I'm seeing also is that the population growth numbers, they're going to be really, really down like this year, like up by a lot, you know, because a lot of the population growth has been driven by immigration. And now that, hold on, let me see if I can pull it up by year. US. Let me see.
I pulled up it.
Okay. So this is from the census. I was looking at this other chart. Okay, so right here, you can see this trend line for population growth by year. And if you look at the last 5 years, you basically had this giant move down during COVID. And then because of all the immigration, things like kind of picked up. But damn it. Okay, here it is. Yeah. But they didn't break it down by immigration. Damn it, there was a chart that showed like a much better thing, like a breakdown. Okay, right here. No, this is not it. All right, you know what? I'll find it another time that we could talk about it. But basically, most of the population growth that we've had over the last like few years have primarily come from migration. And okay, I think this can actually show it. Yeah. If you look at this right here, you can see here the rate of natural increases is barely anything. Most of this increase that we've had is primarily from migration, from net migration. This is from 22. Damn it. You know what? I'll find it and we can actually talk about some more updated information. But basically, this is going to cause huge deflationary wave to hit us also. So I'm seeing like two different things that's probably going to cascade into a deflationary impact. So I'm wondering whether it's not a bad idea for our portfolio to be a little bit more fixed income heavy so that we take advantage of the yields. Okay, no, I found it. Hold on. There we go. This is the one. So you can see here this projected amount in 2024, that giant spike. By 2025, even though this is old, population growth numbers are saying that it's going to grow by like 1%. I don't think that I don't think that's going to net migration is not going to be this number. It's going to be much, much lower. And actually, if the deportations actually accelerate and people actually even do self deportations, bro, we could see like a population growth rate of like maybe 0.1, which could be very, very deflationary.
Yeah.
You know, so just food for thought. You know.
Yeah. Let me, the thing that I want to show is going back to what you were talking about. And then I know you're probably
Sorry,
wanting
but I
to-
gotta head out. So I'll talk to you later, though.
You gotta head out.
All
All right.
well,
Thank you, brother.
I'll see you later. Take care.
Talk to you in a little bit.
Bye.
This is the last thing I want to show. So Mr. Patel was talking specifically around, did it disappear? Oh no. All right. Well, I was using Grok to basically pull up the last 5 years across a bunch of different cities, LA, San Francisco, Austin, and you are seeing a peak in 2023 and a slight pullback in 2025, unfortunately. So I didn't think Chris was wrong with respect to that, but I just think it's not necessarily massive, right? I don't think you're going to go back down to 2020 levels or 2021 levels. I think you'll, probably level off at where they're at today and continue. And I think a lot of that is observed as well with housing prices that I've seen. I've seen prices basically since I moved back from Trinidad back in 2020, obviously skyrocket 2021, 2022, peaked out in 2023, and then really have slowly come back down. But nothing is cheaper than when it was back in 2022, 22. So, well, yes, you've taken a retracement. You aren't really on a graphic. If you were to draw it, yes, things have spiked up, but they've come down. But and I always use this analogy, right? And I think this is a perfect one. U.S. e-commerce growth over the past 20 years. This is a perfect graphic that, let's just see. No, that's not what I want. Total U.S. e-commerce as a percentage of total sales in U.S. over 20 years. Is this it? Yes. Let me share. So this isn't exactly the graphic that I like to show, but it does show it. So let me just do this and then bring it back so that hopefully it shows up. But what you're seeing on the screen here is the percentage of e-commerce comparative to total retail sales in the United States. And so this is basically over the last 10 years time. And if you actually project it out to 2010, you'll see that it's like 1 or 2%. So it's a straight line pretty much. So if you were to, let me get to this graphic. If you were to, I'm hoping you guys are seeing my pointer. If you take this blue line, which is kind of the average, obviously it spikes up during the fourth quarter because obviously people are using stuff to buy Christmas sales, etc. They're using Amazon and stuff like that and having it shipped. But if you kind of draw this blue line, you'll see you go from 7% to pretty straight line. What is this? 16% or so, maybe close to 16.5%. But during the pandemic, you see this massive spike up, right? But by no means, even after things calm down and things kind of go back to normalization, it just meets this normal trend line or regression line that you kind of saw here. So that's what I anticipate a lot of what was going to happen with respect to rent. I don't necessarily forecast it to go in a massive decline back to where it was prior to 2021, 2022. And in fact, I think it's going to probably arrest there and grow slowly from there on out. But anyway, I just want to thank everybody. Over 200 people in the chat on average throughout the entirety of the night. We spiked up around 200, 235 people. It's a testament to showing that you guys are really enjoying the product that Chris and I put out Unfortunately, we haven't been able to meet up for the past month. We've either not been able to make schedules work or anything, but we try to be consistent. So if you aren't already subscribed, hit the bell notification. We'll hopefully be able to do more regularly, hopefully once a week at a minimum, and hopefully eventually get back to a twice a week sort of cadence. You guys rock. I truly appreciate you. For the folks that signed up for membership, Andy, Hail the Great for the 5 gifted. I hope you guys continue to enjoy the show, and you guys rock so much. I'm going to go and get ready for bed. Obviously going to hit the office tomorrow, and you guys rock. And yes, next time anything like this happens with respect to tariffs or this, that, or the other, we need to get Ja Rule on, because at the end of the day, when tragedy strikes, we know we need to hear from nobody else but Ja Rule. You guys rock. I'm hitting you with the outro, and see you guys next time. Cheers.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good. Huge upside potential, upwards of $60,000.